In this video, we talk about different types of documentary credit. Documentary credits, DCs, come in various forms, various types, various characteristics or features, and these are tailored to meet specific needs of the trading community. We will address different practical applications or advantages of each of these features, and then we will compare as to how in the buyer and seller world of complexity this serves as a risk mitigation tool. Confirmed documentary credit. A confirmed documentary credit is a one that involves another bank, a second bank other than issuing bank, which will add their additional promise to pay the importer, an additional layer, an additional security, an independent promise, different and separate from the issuing bank's promise, independent of the issuing bank. This confirmation is upon the authorization of the issuing bank sometimes and mostly at the request of the beneficiary. The key feature of confirmation is that the confirming bank assumes liability for payment even if the issuing bank defaults. Typically, when the issuing bank operates in a politically unstable or economically volatile region, confirmation is sought by the beneficiary. It provides extra layer of security. Transferable LC is another type. The purpose of confirmation is to give additional confidence to the exporter. In a transferable LC, it allows the original beneficiary, the first beneficiary, to transfer the LC to the second beneficiary and ultimate beneficiary because the first beneficiary is an intermediary or a trader and not a manufacturer or owner of the goods, while the second beneficiary will be the actual manufacturer or shipper of the goods. This transfer can be in part or in full, and it can be transferred only once. The second bene cannot transfer to third beneficiary, but second beneficiary can transfer it back to the first beneficiary. The key feature is that it allows intermediaries to fulfill orders without using their own funds. The transferring bank must verify that the transfer complies with the terms and conditions of the credit. And for example, if there is a Singapore company which is a trader and they receive an LC from a buyer in Europe, the trading company in Singapore doesn't have goods on their own, say they will have to transfer the LC to somebody in India, Malaysia, China, who will actually produce the goods and then they will supply. Let us look at another type of LC which is called Red Clause LC. In a Red Clause LC, it provides upfront financing to the exporter before shipment. It is named after the red ink traditionally used to highlight the advance payment clause. This says that either the nominated bank can give advance to the shipper, and if the shipper doesn't ship on time and no documents are presented and no payment could be collected from the proceeds, then the bank can claim back from the issuer for the advances made. Second is beneficiary can present a advance payment requirement under the LC, which will be passed on to the issuing bank, and the issuing bank will make an advance. Both the structures are available in the market. This structure of Red Clause LC allows exporter to get a partial payment as advance to take care of pre-shipment requirements. Commonly, these are used in industries where upfront costs are little higher. For example, in textile, this is used because they will have to use the advance for purchasing the fabrics for preparation of the garments, for example. Then let us look at back-to-back LC. Back-to-back LC are technically two separate credits. They allow intermediaries to fulfill orders by using the original DC as a collateral. The intermediary will have to have a credit facility with their bank to issue a back-to-back LC. And the incoming LC is used as a collateral to have the outgoing LC issued, and the payment for incoming LC will be paid only against the payment received from the outgoing LC. The key feature is that it facilitates complex supply chain where intermediary has to rely on third-party suppliers and they don't have any goods of their own. The first DC or the incoming DC is a security, while the second DC or an outgoing DC is the child or a daughter LC. there has to be a precise alignment between the terms and conditions of both the documentary credit, or else documents presented under one cannot be sent through the other. It will turn out to be discrepant. So if you are a trader, you will use a transferable LC or a back-to-back LC depending upon the situation and banking facilities that you can command. Now comes the revolving LC. Revolving LC, it can be automatic or otherwise manual. You have to trigger. It can be cumulative or otherwise. That is, if a particular shipment is not made, the next shipment cannot be made or not. So these are some of the things that happen in revolving LC. Revolving LC is one that automatically renews for multiple shipment over a specific period of time. There is no need for having a fresh amendment every time or a fresh LC to be opened. So this revolving, or the amount that will come that permitted to be shipped, that is a multiple shipment, this can happen on a particular date. For example, 1st January, 1st March, 1st April, 1st June. It can happen every month. It can happen every year. It can happen at every shipment. It can happen when documents are presented. It can happen when documents are accepted. So the trigger for the renewal should be ideally automatic, and it should be defined in the letter of credit so that the exporter will know when they can make the next shipment. So this simplifies recurring transactions. So new LCs or new amendments need not be created between existing party for one large order. So it can be cumulative or non-cumulative. That is, unused amount can be carried over or not. And then when the reset will happen, on which dates will the value will be reinstated, etc. This is ideal for long-term contracts, provided you are making monthly or periodical regular shipments. Now let us look at how the document preparation has to be done, or what discrepancies could come in. One of the common discrepancies is a mismatched description or missing signatures. Some information is not there, or some information is mismatched, or some information is incomplete and incorrect. Absence of data or incorrect data is a room for discrepancy. Then comes how it can be managed. It can be managed by meticulous verification of the LC per se, the contents of the document, and whether they are remaining consistent or not. There has to be professional training to document checkers. The skill set should have to be enhanced. Maybe you can use new fintech like a document checking softwares. And then, as an importer, you should also call for pre-shipment inspection certificates. So these are some of the ways in which you can manage to prepare proper compliant document and avoid discrepancies. Now, why in the first place will somebody have to use the letter of credit? Letter of credit has to be used if you want to mitigate the risk of the buyer not paying or buyer's country not paying. It protects the importer. Second is to comply with regulations. In certain countries, letter of credits are mandatory. Then it facilitates cash flow management, because under LC you may take advance from your from your advising bank, or you may have a red clause LC, or you can use a transferable or a back-to-back LC, or the once the moment the goods are shipped, you can have it discounted and improve your cash flow. So there are multiple ways in which the cash flow can be managed using a letter of credit. By agreeing for a 90-day letter of credit, you are postponing your cash outflow as an importer. Goods are shipped before payment is made. In an open account, goods are shipped before payment is made. And then they wait for the payment. Payment may or may not happen. There is only a risk in the open account. So open account works only between parties who are well known to each other. They are well trusted. The disadvantage of open account is that risk of non-payment, and this will work only if it is small value. For higher value, people will insist on some other guarantees. What is cash in advance? Another form of open account where money is paid first and then they wait for the goods to come. Goods may or may not come. Quality, quantity, etc. may have problem. That's a different problem altogether in an open account. The disadvantage is that risks faced by the importer regarding standard of goods and the strain on the cash flow. So the payment terms, open account has certain benefits for certain parties, cash in advance has certain benefits for certain parties. The documents are what banks rely upon. So it is very important to ensure documents are not fraudulent, there is no forgery, and they are 100% reliable, and the data in them are complete and correct. Thanks for watching this video.